I mean, it depends on your time frame, but certainly tactically on the next sort of month or two, we think there's going to be a bit of a pullback in markets, a sort of 4 to 8% in the S&P type pullback. And to be honest, that's kind of normally what happens at this time of year. It's the norm for a pullback in the first quarter. And if you think about how far we've come an awful long way just since the local lows we had just before the election at the end of October last year. The S&P hit a local low on the 30th of October. And markets since then are up around 20 to 30%, depending on which index you pick. So we built in an awful lot of good news into the price, the vaccine, the presidential election, couple of fiscal stimulus bills, and markets seem quite toppy, a little bit euphoric to us here in the near term. So I think there's every reason we might give back a bit of gains. A lot of good news in the price, therefore the market's a little bit vulnerable, I think, to any sort of negative news flow that might come through.
Where's the alarm bell ringing here, though, Chris? Because if you look at those traditional measures of early distress, maybe you'd look at the high yield bond market, for example, and yet I think we saw yields again tightening up a little bit over the last few days. Doesn't that suggest that actually this euphoria can run a little bit longer, that no one's quite ready to walk away yet?
Well, that's kind of what typically happens as you build to a wave of risk aversion and pullback. I mean, really, markets over the month-by-month basis are driven by fear and greed. And so they get extremely greedy, euphoric, and then suddenly they reverse. And it's very difficult to predict the trigger. It just suddenly comes about. So in our minds, what our models are saying is the market's got euphoric, and it doesn't happen very often. It happens once or twice a year, perhaps. Excuse me. And then you get this kind of pullback playing out. So it's very difficult. So you'd expect high yield spreads to continue to tighten until you get that sort of rolling over and sharp give back in markets. So that's what we're seeing. Really, it's a model-based view. It's a view looking at how far markets have come. It's a view suggesting they're quite greedy in the near term, and therefore they just need a bit of a washout. They're kind of tired. Karen earlier was talking about that rotation we saw in the US yesterday, which I thought was quite interesting. We had a very good move in cyclicals at the start of the year, and now we're getting a bit of tiredness in cyclicals and a bit of rotation. Last gasp to the upside in tech, in my opinion. So yeah, I think it's normal what high yield spreads are doing, and I think that's typical as you build to the local high and a bit of a give back, a bit like we saw on the 2nd of September. You remember tech was very toppy in the run up to that high that we saw there on early September last year.